The University of Michigan, which has been tracking the data since 1952, citing cost pressures from surging gas prices. Joining us for more, Jim Bianco, president of Bianco Research. Jim, great to have you with us.
Thank you.
You know, this is sort of the same conversation that we were having about the broader stock market, and that AI is sort of papering over the various weaknesses. Headline numbers on all the economic data seem to be fine. Maybe it seems to be stronger than you expect, but then you see little pockets of weakness like this consumer sentiment number. And granted, normally, you know, markets don't move on consumer sentiment, but it's not just this. It's a commentary that we've heard out of corporate earnings about the consumer being stretched. I mean, Kraft Heinz saying at the end of the month, their consumers are running out of money. I mean, at what point should we start paying attention to these sort of anecdotal and sort of these softer measures as opposed to the headline data, which will paper over some of those weaknesses?
It depends on who we are. If who is a politician, you should be panicked about this right now. If you're investors, maybe not yet. And what I mean by that is consumer sentiment at a 74-year low, according to the University of Michigan. That is the broad measure of lots of people. But let's remember, according to Mark Zandi, that about half of all consumer spending that is done by the top 10% of income. They're doing fine. They're spending fine. The headline numbers will continue to look good. And so they will power along all of the economic data higher, but the masses of people, as expressed by the University of Michigan consumer sentiment, are very unhappy. And as you pointed out, they're very unhappy about affordability. Prices are too high. There's too much inflation. There's too much accumulated inflation. What I just described is the K-shaped economy, and it's getting more K, if anything, if I could use some bad English there.
No, and Jim, as you know, Michigan typically skews towards inflation, as you just said, which is why it is where it is. And my question to you is, you know, the Federal Reserve finds themselves in a really awkward position, I think. I don't think they have a rate cut. I saw Steve Leisman today priced in until September of 2027. And there's just as much chance now to rate hike as a rate cut. I mean, does it even matter at this point?
Well, it matters for the president because he's getting his new guy next week. Jay Powell's term's up 1 week from today, and Warsh is going to come in, and there's high expectations from the president. He's going to be cutting rates. And I don't think Kevin Warsh, not only can he make an argument to cut rates, I don't think he even has the votes at this point. He's got to get 6 other people on that committee to vote with him to cut rates. So the Fed is on hold right now. But let's remember, 2 months ago when the war started, we were pricing in 2 or 3 rate cuts. If this war continues to drag on and prices go up, there's an argument to be made by the middle end of the summer. We could be talking about rate hikes at that point. You know, if the war ends and things settle down, then that'll go away. So we are moving in that direction towards rate hikes right now. But you're right, rate cuts are off the board for a long time.
Jim, Tim, switching gears a little bit. Once again, we got right up to that 445 level on the 10-year and didn't break higher. We've talked often with you about the dynamics around the deficit, around refunding, and some of these periods where we get the TRA, and sometimes it matters, sometimes it does not. Bad English on my own here, sorry. Where are you on this? I realized today was a day where the 10-year liked kind of what the payroll number taught us. Are we just missing this move higher in rates that's about to hit?
Yeah, you know, for the last several years, I've argued that the low in rates, probably the low for a decade or two, was August 2020, 50 basis points. That's not a hard call. It was 50 basis points. It's going to be harder to get lower than that. And I also don't think that the rate hike or the rate rise, I'm talking about the 10-year yield, ended when it went over 5% in October of 23. I still think we're going to go higher than that, maybe over the next year or so. The last couple of years, you're right, the 10-year yield has been 4 something. So it hasn't proven me right, and it really hasn't proven you wrong. It's just kind of been sitting there sideways. I think what we're going to see is we're going to finally see that move higher. And the reason is the economy's doing well. You guys were talking in the previous segment about earnings, about the stock market. You know, we had a decent payroll report today. The economy's doing well. We're just creating more inflation. And if you're creating more inflation with the economy doing well, then the path for yields, bond yields, is going to be higher. And I think we're probably going to see that 5% yield in the next year. Now that I've said that, I don't think it's a problem. I don't think that if we see the 5% yield, yeah, people in the real estate business won't like it, but it's not going to be a drag on the economy because that's the natural rate that it should be doing, is going up.